In his 6 years at RBI, Governor Das has used conventional, unconventional, and sometimes innovative policy measures to preserve financial stability while mitigating the impact of threats ranging from a once-in-a-lifetime pandemic to everyday inflation. Governor Das will be in conversation with Reto Gregory, Deputy Editor-in-Chief of Bloomberg News. Reto, it's over to you.
Thank you so much. Governor, thank you so much for joining us. It's an honor to have you here at our first India Credit Forum. I'm sure everyone here will want to hear your views on the latest inflation print and the outlook for interest rates, and we'll get to that in a moment. But first, I'd like to step back a little. Everyone is talking about India these days. You just overtook China as the world's most populous country. Economic growth is also outpacing China's. Indian bonds are being added to international indexes for the first time, and local equity markets have been going gangbusters. Some call it India's moment. Others say it's now the world's most crowded trade. Some even say there might be an India bubble. In view, how would you describe it? Is it India's moment? Is it a crowded trade or a bubble?
Well, thank you for inviting me, and thank you to all of you. I have been participating in Bloomberg events. I participated, I think, one event some 4 or 5 years ago. Am I audible to the audience? Yeah, okay. So I heard part of what Menka mentioned. I think she has done, she has said all the good things about RBI and what all we have done. But I just, I think if I am right, I heard her mentioning that also policing the credit market. Now, we are not policemen. We are watching the very closely. We maintain vigil over the credit markets. And when there is a moment when it becomes necessary, we take action. But coming to your point, I think I would broadly agree that this is India's moment, because India's growth story is intact. Inflation has now come very much within the target range. It is expected to moderate, but there are risks. In fact, there are significant risks, and we are very careful in monitoring the overall outlook with regard to both growth and inflation. And the balance between growth and inflation is well poised. So far as the credit market is concerned, the bank's overall financial parameters, the performance indicators of the banks in financial terms are very robust, and deposit growth was a bit of a problem, that is the gap between credit growth and deposit growth. But now the gap between the two has been considerably narrowed. And so banking sector is doing well. The other source of credit which has emerged in the recent years is the non-banking finance companies. Now, non-banking finance companies roughly occupy about 30% or so, about 1/3 of their asset size is, their loan books, their portfolio is about 30% or 1/3 of the books of the banks. So that is one sector which is emerging. Within NBFCs, we have also a special category of non-bank finance companies called ICCs, that is investment credit company, infrastructure investment and credit companies. So that also is showing good progress. And then we have other, other instrumentalities, other mediums like the REITs and the InvITs, and of late the alternative investment funds. So multiple track now funds are available to the, for the credit market in India. I'm not talking so much about the retail credit. I'm talking about the credit for the overall broader economy. And also then there is, of course, the foreign, foreign investment, which is coming both through the FPI route, the foreign portfolio investment route, as well as the other routes like the external commercial borrowings, etc., which have shown good progress in the recent years.
Prime Minister Modi has set a goal for India to be a developed country by 2047. To achieve that, gross domestic product would have to grow more than 6-fold, which seems like an incredibly tall order in less than 25 years. In your mind, what should India focus on to get there? Is it infrastructure? Is it job creation? Is it tackling inequality? Is it even opening financial markets further, or a combination of all?
I think it has to be a combination of all. In fact, in India, there has been considerable amount of discussion in the public space whether it should be, whether it should be a manufacturing-driven growth or a service sector-led growth, or whether it should be led by this or that. But I think for a large economy like India, for a large population like India, it has to be, we have to follow multiple approaches. It has to be, on multi-sectoral growth, which has to happen. And overall, the size of the GDP is growing, and the investment, the overall domestic investment has remained around 30% or so over the years. But in gross terms, in absolute terms, it is obviously, there is more investment happening. And 2 or 3 areas which I would like to emphasize is, I think the first is manufacture. First is, the infrastructure sector. On infrastructure, good progress has been made in the recent years. And I think government is giving considerable amount of emphasis on infrastructure development, not just on large infrastructure projects, but also on rural infrastructure projects, which is very essential, especially for the large cross-section of Indian people who depend on agriculture. So rural infrastructure would include basically roads, provision of electricity, then access to agricultural markets by transport network. So infrastructure, and also the port network is improving. Airports, there have been significant progress over the last few years. So physical infrastructure, there has been considerable amount of improvement.
I mean, the World Bank says that India would need something like $840 billion through 2037 just for the urban infrastructure. The government obviously is going to pay for a lot of that, but what's the role of the private sector, and how can you attract more private sector money?
I'll just come to private sector. Before that, just one sentence on infrastructure. It's not physical infrastructure, but I think it is also the digital infrastructure where India has made excellent progress over the last few years. And then, of course, if you treat human capital as a part of the broad infrastructure which supports the economic growth, there is considerable amount of emphasis on skilling, reskilling, etc. Now, I'm not getting into the number about how many billion US dollars are required for India's growth, but again, India has to sort of tap the domestic resources through multiple routes. As I mentioned, the non-banking finance companies, banking sector, yes. Then there are certain all India financial institutions which are now specifically focused on infrastructure sector. Then we have to, of course, use this REITs, InvITs, and considerable amount of opening has been done so far as the foreign investment in India is concerned. And we need to also tap in a lot into the foreign capital. That is something which is happening. On the external commercial borrowing route, for example, the Reserve Bank, 3-4 years ago, we have liberalized and opened up the, that particular channel for accessing funds from the foreign markets, commercial borrowings from the foreign markets. So through multiple sources, it is happening. There are significant, there are important issues to be addressed in opening up further issues, in the sense that, we have in our interactions with foreign portfolio investors or foreign direct investors, we do they do point out what are the impediments and what are the challenges they are facing. And we try to address those issues in consultation with our other regulators in the financial markets, like the securities market regulator, for instance.
What's the biggest complaint you're hearing from foreign investors?
I think there are some complaints about KYC related issues, know your customer related issues, and knowing the ultimate, the beneficial ownership of investments. Now, this is not something which is our creation, but this is a FATF requirement. This is a FATF requirement, and rightly so, given the context of today's world where, there are money can come from many sources. One has to be very careful about which sources, the sources from where money is coming, who are the beneficial owners. So it's in compliance with the FATF requirements. Naturally, there are KYC related issues. So there we get, often representations about issues relating to procedural issues relating to know your customer, that is the KYC related issues. And that is being addressed not just by us, but also by the securities market regulator. Particularly for foreign portfolio investors, it's more to do with the securities market regulator, the SEBI, which is dealing with it.
Which we'll hear from SEBI in a moment. On the bond market, Menaka mentioned it's growing. But still, the corporate bond market is still only about 16% of GDP, which is lower than in other big economies. Are there any policy steps that India should consider to expand that particular market?
You see, bond market, quite right, it has grown over the last, I would say in the last decade or so. It used to be about the annual fundraising through the bond market was in the order of about 3.7 trillion rupees or so per, the annual bond raising of resources through bonds. Now, the latest last year, it was about 8.6 or 8.7 trillion Indian rupees. So it has considerably increased. We have taken, the Reserve Bank has taken a few steps in the recent years. For example, there is a partial credit enhancement the Reserve Bank has facilitated. Then we have now permitted, the corporate bonds also to be treated as a part of the HTM holding of the banks. We have recognized that. So like that, number of steps have been taken. And for major projects, there is a requirement. We have mandated that 50% of the resources should be accessed ideally from the bond market. So we have taken number of resources. But it's a work in progress. We have to there are issues to be addressed. We have to be taking more number of measures. First thing is that, the number of institutions which are participating in the bond market, it's mainly the banks, the insurance companies, the mutual funds, and the pension funds or the provident funds as we call them. So we need more of institutional investors to come in. This is again one area where the foreign investors can come in. There is a certain cap provided considering the prudential, there are prudential caps, that is ceilings prescribed for that, but it has not been utilized. Only 15% of the total space which is available for foreign investors to invest into the Indian bond market, only 15% of that has been utilized. So there is considerable scope to access the foreign funding, that is foreign investors into the corporate bond market.
So how do you take
and
the
finally,
other 85%?
just one more point. Finally, I think we also need to focus on, and we are focusing on, developing a robust secondary market for corporate bonds. I think that is something which we are working on, and that's something which will, I think, add a lot of momentum to the corporate bond market. Yeah.
Private credit is the buzzword at the moment. Everyone is trying to get into private credit. What's your 30,000-foot view on this new asset class that everyone is trying to get into? Good thing, bad thing?
You see, at the global level, I think private credit is increasingly becoming, it is posing certain risks, and I think every central bank or every regulator should be looking into that. Private credit, the quality of credit appraisal or the quality of collateral, there are certain underlying risks. I'm now talking about at the global level. And the resilience of private credit in a downward credit cycle, or when the economy is entering into a more challenging phase, when the economy is entering into a more stressed period, the robustness and the resilience of private credit is yet to be tested. So therefore, there is need to undertake stress testing of private credit in multiple hypothetical stress situations. Now, so far as India is concerned, it's not a problem at the moment, in the sense that private credit in the Indian context is mostly offered by the non-banking financial companies, which are regulated by the Reserve Bank. And 3 years ago, we have completely recast the regulatory architecture for the non-bank financial companies. We have a scale-based regulation now. Depending on the size and complexity, the regulatory requirements and the norms are, stringent. depending on your size and complexity. And if it's a small entity, not very complex, a local level entity, then the regulatory requirements are rather benign. So therefore, it is quite a well-regulated sector. In India, at the moment, we don't see any problem. One area we saw some risks building up, some potential risks coming up, and that has been addressed already, is the alternative investment funds, the AIFs, the structure of AIFs. We noticed some discrepancies, some deviation from the norms, and we saw some risks building up. So that has already been addressed. We noticed it in time, and on a proactive and a preemptive basis, we have prescribed regulatory instructions in that regard. So that is by and large well contained and well managed. So far as India is concerned, I think private credit has a lot of distance to cover. It has to grow. But at the moment, we don't see the kind of risk which we see at a global scale. I mean, at a global scale, meaning in the rest of the world.
Currencies, the rupee has stayed relatively stable compared with its peers. From you, there's been a big push to build up foreign exchange reserves over the years. You've accumulated more than $300 billion during your term in office. Do you feel there's a need to continue to add to the reserves, or are you done?
No, we have no specific target so far as building up of reserves is concerned. You see, I'll tell you from where we are coming. We saw not long ago in 2013, India experienced, like many other economies, the taper tantrum. And taper tantrum, eventually nothing happened, but just, a couple of statements were made. And the kind of volatility it created in the forex market with regard to the capital flows. I was at that time in the finance ministry in the government. So I have seen the kind of volatility the markets witnessed and the kind of stress with which the Reserve Bank the challenges which the Reserve Bank of India had to deal with. Now, we cannot have a repeat of that situation. India is growing, the size of the economy is growing, and there are we cannot be depending always on global safety nets. In today's world, I think each country has to build up its own safety net. So we are coming from that background. In that background, we have been, whenever there is an opportunity, whenever the market offers an opportunity, we are building up reserves. And they have now crossed 700 billion, the figure which will be released later today in about an hour's time. It has come below $700 billion. That is mainly because of the revaluation, some amount of valuation losses in the securities and in the currency losses, etc. But that's not much, and we'll again go back to 700. So we have no such target. Whenever there is an opportunity, we are building up reserves, and I think a large economy like India must build its own resilience, must build its own buffer, must build its own capacity to withstand, the capital flows. If forex is coming in, if capital is coming in when the cycle reverses, it can go out with in equal size and speed. And we should be prepared to deal with that kind of situation where capital flow causes a problem. And with regard to the currency, the Indian currency has remained pretty stable, is the least volatile. But one point which I think I would like to share here is that if you look at on a, let's say, 2.5 year horizon, if you look at from the beginning of 2022, and the Ukraine war started in February 2022, and inflation went up, and the tightening cycle started from March, April onwards of 2022. So from January 2022 till now, the rupee depreciation vis-a-vis the dollar is about 11.5%. The dollar has appreciated during this period by about 8 or 8.5%. So rupee has been depreciating in response to the overall movement of the dollar and the overall movement of the international market. So it's not as if, why I felt it necessary to clarify, because sometimes there is an impression that, and I'm not being defensive about it, sometimes there is an impression as if we are managing the exchange rate. We are not managing the exchange rate. Rupee is depreciating overall, vis-a-vis the dollar, and we buy the dollars whenever there is an opportunity. And when there is a dollar shortage in the market, we supply dollars to the market.
I mean, history shows, if you look at Japan many decades ago, or China, more recently, if you have accelerating growth, that your currency tends to appreciate. I mean, can investors expect a appreciating rupee in the future?
I can't say that. I can't say that. At the moment, the depreciating pressure is there, but that it is, it is broad. It's not very volatile. There is some depreciating pressure which was witnessed in the last few days. But at the moment, I think it seems to have again stabilized, and it is mainly because I think you see what is happening is in earlier episodes of in earlier occasions. What was happening is that some data point would come somewhere, some data point will come somewhere, and immediately the Indian markets would respond, and immediately there will be a movement, outflow of dollars. Today it is not happening because overall the Indian economy is resilient, the macroeconomic fundamentals are stable and strong, and there is confidence on the part of, confidence on the part of the international investors. They have greater confidence that whatever is the requirement, India will be able to meet its, external payment obligations.
Interest rates. So you shifted your policy stance to neutral at the last meeting. You didn't cut. Some critics have said that you're running the risk of being behind the curve, hurting the economy. Then September inflation came in higher than anticipated. Do you feel vindicated?
We expected, say, September inflation to be high. In fact, I had, if I remember correctly, in my statement, monetary policy statement, exactly 9 days ago, on 9th of this month, I had said that in September, we expect a big jump in the consumer inflation number. And we expect also a higher number in October also. But thereafter, in going into November and December, in the third quarter of this, in November, December, we expect inflation to moderate. And with regard to being behind the curve, I would like to say that, there can be a difference of opinion between certain sections of opinion makers or certain section of the market. But so far as Reserve Bank and the broad, overwhelming section of the financial markets are concerned, I think expectations and thoughts are quite well aligned. The opinion poll, the polling conducted by various news, the wire services and business channels, most of them had said that Reserve Bank will not cut, but Reserve Bank will change the stance, and that was exactly our decision. So I think market expectations and Reserve Bank's policy, they're well conversed. And I would like to say that certainly we are not behind the curve. Indian growth story, as I said in the beginning, the growth story remains intact. India is poised to grow at 7.2% according to the projection which we made in the last Monetary Policy Committee meeting. Growth is holding on, growth is steady, growth is resilient. Inflation is moderating with certain risks about which we have to be very vigilant. So therefore, rate cut at this stage will be very premature and can be very, very risky. When your inflation is 5.5%, and next print is also expected to be high. Right. You can't be cutting in, rate at that stage more, at that point. More so if your growth is also doing well.
Some economists have pushed out their forecast for a rate cut in December. Would you agree with that view, that we have to wait a little longer? You would miss the party if you don't cut in December. So
far as the Reserve Bank is concerned, you asking about India? No, we will not miss the party. In any case, we don't want to join any party. we would rather like to wait and watch. And if we decide to join the party, we would like to join it on a durable basis. In the sense that when we have confidence that inflation is, the inflation figure is durably aligned with our target of 4%. Only at that stage, maybe that may be a situation where we can think of. But I think it's too. I would not like to, make any forward. I would not like to give any guess in advance that we are going to cut or anything. I think we'll have to wait and watch. We have to wait for the incoming numbers, and please mark my words very carefully. We have to wait for the incoming data, and More than that, we have to also, we are more dependent on what kind of, what kind of outlook we have out of, ahead of us. So it will depend on the incoming numbers. It will also depend on the overall inflation outlook, because policy has to be basically forward looking. So we have to see what is the future outlook next 6 months or 1 year down the line. Based on that, we would take action.
The Fed obviously pivoted with a bang and the jumbo rate cuts. How much time do you spend on watching what other central banks, especially the Fed, are doing?
No, we do watch. We do watch what other systemic banks are doing, in particularly the Fed, because it impacts almost every economy in the world, and we watch it very closely. Having said that, I would just like to add, and I have done that before also, that our decisions are primarily dependent on the domestic inflation, growth, and macroeconomic situation.
Staying with America briefly, are you concerned about the potential imposition of new tariffs in case Donald Trump is being elected in the US? He was on a Bloomberg TV interview this week where he said tariff is his favorite word in the dictionary, and higher tariffs would basically solve all the problems of America. What's your view on that?
No, I don't want to go into what I'm saying, I don't want to link it with an election outcome, because I think world over, the people who predict on election results, I think the track record of late has not been so good. And, yes, overall, I think geoeconomic fragmentation globally is becoming a problem. And we have enjoyed the fruits of globalization. We have enjoyed the fruits of, world becoming what was called at that time, the world has become flat. Every country benefited out of it, but I think globalization probably somewhere traveled on a different direction. So various countries, the benefit that individual countries derived out of globalization was divergent. So therefore, globalization has been questioned in the recent years. But I think overall, the spirit of globalization, the need for globalization, the need for greater role of multilateral institutions and avoidance of trade restrictions and avoidance of unilateral trade restrictions or geoeconomic fragmentation. I think these are impediments for overall global growth, and there is need for greater, there is need for greater cooperation and understanding across countries on these areas.
Your current contract comes to an end in December. If you look back, what are you proudest of in your tenure, and what would you do differently if you could turn back the clock?
Well, it's for others to judge. It's exactly 10th December, I remember the date. And I think during the last 6 years that I have been in the Reserve Bank, and let me preface that by saying that we have an excellent team in the Reserve Bank. I'm not saying it because some of them are present here or some of them would be watching, but it is a fact that I think we have an excellent team in the Reserve Bank, and together we have worked. And I think we have, seen India through in one of the most challenging phases in its economic history. When I joined the Reserve Bank in December 2018, a large non-banking finance company had, collapsed. The financial markets activities in the financial markets had frozen. There was a crisis of confidence in the financial market. We dealt with that challenge by infusing liquidity, by monitoring, supervising the financial entities with greater rigor. Then we had, that was in 2019, 2020 we had the COVID, continued till 2021. Then 2022 we had the Ukraine war, followed by, spike in inflation, synchronized monetary policy tightening across the world, and the spillovers to the emerging economies, including India. Then the crisis in the Middle East, and alongside we had geopolitical crisis and geoeconomic fragmentation. So I think it has been a very challenging period for the last 6 years. And what gives us satisfaction in the Reserve Bank, but satisfaction doesn't mean that it's time to celebrate. I mean, because every day is a new challenge. Every day poses new problems. And I'm not saying it in a very, with just to indulge in some semantics. I really mean it. Every day is a new challenge. The world is changing. We cannot be complacent. And but what gives us the large satisfaction is that we, I think, navigated this period with big success. The economy today remains, the macroeconomic fundamentals are resilient. Financial stability has been well maintained. And if you ask me what has been the biggest achievement of Reserve Bank during the last 5 to 6 years, I think it is maintaining stability of the financial system, maintaining financial stability. In fact, the Indian economy and the Indian financial sector overall today is much stronger than what it was before we entered this period of crisis. And that is something which I think I and my colleagues in Reserve Bank, we sort of discuss about it. There are learnings from it, and there are takeaways for the future. And we always, the effort has been to remain alert and try to see where the risks or where the vulnerabilities can, build up and try and address that issues.
You seem to thoroughly enjoy your job. If they ask you to stick around for another term, are you going to accept?
At the moment, I have this injury. I have to get over this injury. No, but on a serious note, I think, at the moment, that is certainly not in my mind. I'm being very frank about it. In my mind, what remains is that, up to 10th December, there are certain items which were initiated, and we need to, conclude them. We need to ensure that they reach, their desired conclusion. Several discussion papers we have given out in the public domain. We have adopted a consultative approach in framing our regulations. So several discussion papers have been placed in the public domain. The comments have come up. I have asked my colleagues in Reserve Bank to try and examine those comments, and our effort will be to try and issue whatever regulatory guidelines or directions arising from those discussion papers. My effort is at the moment completely focused on, completing that job. And next monetary policy meeting will also come up. So already my table is full. So I have no time to, really think of what next. We will see.
Okay. Well, our screen here says time is up. So sadly, we have to end this. Thank you so much.
Thank you
for coming, and thank you for listening.